Hello, everybody. This is Alan Ellman, the blue-collar investor, with today's option selling question of the day. Today's question comes from Dawn. Alan, I need some help entering a rolling out and down put trade with QQQ using the trade management calculator. I'm not sure how to handle this since there are two different expiration dates. I've attached the trades. Thank you, and it's signed Dawn. Well, there's a lot to unpack in this question because calculating cash secured put trades is relatively simple. But then when we throw in the aspect of exit strategies or position management, sometimes it gets a little more complicated in terms of how to archive and how to calculate each individual step of the trade. So Dawn actually rolled out and down, which is something we usually don't do. But there are a lot of ways of trading. Not everybody trades precisely the same way that I do, and there's nothing wrong with that. So the reason I'm using this particular example in this Ask Alan video is because I feel it has a lot of educational value to it. So let's break it down and see if we can come up with some sensible responses to Dawn's questions. Let's start off by first defining the term, what is selling cash secured puts? Well, that's where we sell some unknown person the right, but not the obligation, to sell their shares to us, the put seller, at the strike price that we determine by the expiration date that we determine. Now, in return for undertaking this contractual obligation, we are paid a cash premium. So we could say it this way: put buyers, not us, have rights. Put sellers, that's us folks, have obligations. And in return for undertaking these obligations, we are paid handsomely. Now, the broker is going to require us as the put sellers to secure that put trade by placing a certain amount of cash into our cash brokerage account in case the put buyer decides to exercise that option and sell their shares to us. The broker wants to make sure that the cash is there to purchase the shares. So the formula that is used in determining the amount of cash that we need to secure the put, or let's say our investment, is the put strike minus the put premium times 100 times the number of contracts. So in order to then sell that put, we've got to secure it by placing that amount of cash into our brokerage account. Next, let's define the term rolling out, just rolling out a cash secured put. Now that's where we buy back the initial short put as expiration is approaching. So normally rolling an option is done as expiration approaches. There are exceptions, but for the most part, this is when we do it. Once we do that, we immediately then sell the same strike put option for the next contract cycle. Now, we typically roll out in the money strikes. If it's out of the money, we usually don't need to do that. But in this case, Dawn did do that. He rolled out an out of the money strike. So we're going to, that's another reason I felt this has some educational value to it, because it's something we usually don't do. So in this particular case, not only was it rolled out, but it was rolled out and down. So let's now define that. What is rolling out and down an out of the money put? And this is where we roll out an out of the money cash secured put to a lower strike in the next contract cycle. Once again, this is a tactic we rarely take, but since it's the one that Dawn shared with us, and I felt it has some significant educational value to it, well, we're going to calculate this and assess it. So now let's have a look at the real life example that Dawn shared with me and that I'm now sharing with you. On July 11th, 2022, the Qs were trading at $290 per share. Now, the Qs, for those of you not familiar with it, is an exchange-traded fund that consists of 100 of the largest non-financial companies listed on the NASDAQ exchange. So the big boys, Apple, Facebook, Amazon, Google, Microsoft, etc. Now, once the Qs were trading at 290, and Don sold the July 13th, 22, so 3 days, Monday, Tuesday, Wednesday, 283 out of the money put. So strikes lower than current market value from a put perspective is considered out of the money. And that generated a premium of $1.22. So the Qs, by the way, have 3 expirations a week. They're wildly popular option underlying securities. So you got Monday, Wednesday, Friday. This was Monday, July 11th, with an expiration of Wednesday, July 13th. Now, on expiration Wednesday, weird to say that, the Qs were trading at 285. So they had gone from 290 to 285, but that 283 strike was still out of the money, lower than current market value. But Don elected to close that still out of the money 283 put at $1.50, and then sold the July 15th, so Wednesday to Friday, again 3 days, Wednesday, Thursday, Friday, at 232. So he closed the 713 put at $1.50 and sold the 715 put at 232. Okay, that's the trade. Now, the question becomes, how do we enter it? How do we calculate it? How do we archive it so it makes sense? Let's get started. Now, in section 1 of the trade management calculator is where we enter the initial trade. So on the screenshot, you could see that the Qs on 7-11 were trading at 290, and the 283 put was sold at $1.22. So far, simple. The section 2 of the trade management calculator will show the initial calculations generated. So it doesn't mean you're going to end up here, but this is the starting point. So that information shows us that we get $122 per contract. That's the premium. And based on a 3-day trade and the amount of cash required by the broker to secure that put, it resulted in a 0.43% 3-day result, annualized out to 52.68%. Now, the spreadsheet will also tell us if the put is exercised and the shares are put to us and we purchase the shares, it tells us we purchased them at a discount of 2.83% from the price of QQQ when the put trade was first initiated. Okay, that's section 2 of the spreadsheet. Now we're going to move on to section 3 of the spreadsheet, which is where we make our trade adjustment. So how do we do this? Well, since there's a different expiration date for the Friday expiration, 7/15, from the 7/13 initial expiration, we're going to close the original trade at, we're just going to close it. So all we do is enter the date that we close it is 7/13. You see the arrow, and the current price moved from 290 to 285. That's all you have to enter in the adjustment section. And then if we go to section 4, which is the final results, so the final results will be precisely the same as the initial results. We're just closing this. We're not factoring in the rolling out and down of the out of the money put strike in this first trade. So the final result is a 3-day return of 0.43%, or $122 cash that's realized at that point in time, where you see the arrows. Now, how do we enter the rolling out and down trade, the second trade, the expiration, the 7/15 expiration? How do we do that? Well, we have to use a net option credit as the premium. So if you look at the second line on the spreadsheet right now, as you're looking at this screenshot, you could see that the entry date moved from 7/11 to 7/13, from Monday to Wednesday. The expiration date moved from 7/13 Wednesday to 7/15 Friday. the price of the stock at that point in time was 285, and Dawn rolled down to the 280 from the 283 strike. Now, the premium, this is the tricky part now. The premium is the net credit from the sell to open of that new strike of 280, which was $2.32, minus the cost to close of the original 283 strike, which was $1.50. So if you subtract $1.50 from 232, then you have a net credit of 82 cents where you see the arrow. And that's how you enter it. Now, if we move on to the initial unrealized return of that second trade, where you see the circled area and the arrow, you could see that based on that net option credit, we have a 3-day return, Wednesday, Thursday, Friday, of 0.29%, which annualizes out to 35.74%. And if the price of the Qs moves under that new strike price, then we will have purchased it at a discount of 2.04% from when this second trade was entered. Okay, so hopefully that makes some sense. Now let's just summarize. Since this series of trades has two different expiration dates, 7/13 and then 7/15, the best way to enter, calculate, and archive these trades is to finalize the first trade where the initial and final calculations are precisely the same. Enter the second expiration put trade on a different line on the spreadsheet, or perhaps even on a different spreadsheet. Okay? And we use the current market value, which was 285 in this case, and the net option credit, taking the sell to open, deducting the cost to close, and that's your net option credit. Now, the way you can do this, folks, is you can keep it on the same spreadsheet if you want, or you could save a separate spreadsheet for each expiration date. Just go to File on the top left, Save As, and name it. For example, TMC 7/13/22. And then another spreadsheet would say TMC 7/15/22. You could do it that way. Or you could take a separate spreadsheet for every monthly expiration and include all the weekly trades within that, however you're comfortable doing it. But just do it consistently so that you know how to archive them and then how to come back and review them when you're reviewing your trades, how to improve upon them. What did I do right? What did I do wrong? It's just a great way we can educate ourselves. And also, our accountants will appreciate it as well, as everything is kept in an orderly fashion. Before I go, ladies and gentlemen, for those of you who are premium members, I want to remind you that the premium member site is the only place where we archive the entire library of Ask Alan videos, over 200 at this point. Just go to the member site, scroll down on the left side where it says Ask Alan. You'll see the first 10, then click on the link where the arrow is, and you'll get the other 190 plus. We add a new one every single month. The topics are on the right side under resources and downloads. You can't see it on this screenshot, but if you go to the right side and scroll down to Ask Alan titles, you'll be able to get the titles, and you can reference the particular videos you're interested in. I also want to mention our two best packages for mastering the strategies of selling cash secured puts and covered call writing. One is our BCI package, our best and most comprehensive investment package. It has 18 components, and that 18th component has over 200, 6 online video courses with downloadable workbooks, 6 calculators created by the blue-collar investor, 5 of our best-selling books in ebook format, and our 13-month annual subscription premium membership, where we give you 4 reports for eligible candidates for option selling, plus over 200 training videos. And once again, we add 1 or 2 every month. The other package I want to mention to you is our BCI trade management package, which consists of the spreadsheet that you were looking at in this video. It allows us to enter our trades, get initial calculations, adjust our trades with over 20 different exit strategy choices, getting final calculations per trade and for the total portfolios. It's the only spreadsheet of its kind anywhere in the world. It also includes a 28-page user guide and my 8th book, Exit Strategies for Covered Call Writing and Selling Cash Secured Puts. For more information on these packages, go to our website, thebluecollarinvestor.com, and click on the link that says Best Discounted Packages. So there you have it, ladies and gentlemen. I want to thank Dawn very, very much for sharing this series of trades with me and allowing me to share it with you, the BCI community. And of course, I want to thank each and every one of you for taking the time with me to review this series of trades with QQQ. I hope you enjoyed it. And most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.